let's go ahead and get started. Sure, we'll have some other folks jump in. Today we'll talk about financial due diligence. As I was putting together the kind of the lesson plan for this, I started to go down a rabbit hole, which didn't make sense. First of all, I mean, most of the due diligence is going to be done by your lender. There's some things that you need to do and look at that your lender may not necessarily pay attention to that relates to some more qualitative information around the acquisition. Your lender is strictly going to be looking at the information in terms of how it impacts, forecasted cash flow moving forward, and that forecasted cash flow, making sure that that forecasted cash flow actually covers your debt service. But they may not necessarily inquire around some of the areas that that would come out of the financial due diligence process. So I started to go down the rabbit hole of actually explaining kind of how to do all of it, but you're not going to do all of it. So I backed up and figured that would end up being a waste of time. So what we will focus on are some of the key areas that you should be looking at during financial due diligence, because again, your lender is going to do a lot of that work for you just through the process of underwriting the deal. They're going to let you know if there's an issue with something related to the business around the financing of it. Your quality of earnings consultant, should you employ one, which, depending on the business and depending on how clean the accounting is, should be a decision in the affirmative in terms of actually using one. But we'll kind of explain the difference between what the quality of earnings consultant will do versus what you should do and what your lender will be doing. And then we'll try to focus on more of the areas that you should focus on around that. So before we kind of jump into that, let's talk about kind of what's been going on out there. Who's got an interesting story to tell? Are there any questions around your particular acquisition you'd like to kind of bring up so that we can all discuss it so that everyone gets the benefit of that knowledge? You guys have anything interesting going on out there?
If you guys want to hear a disaster story here, I was supposed to be in my business by the 29th of May. I left my other job at the 30th of April. And when it came down to it, all the due diligence, we uncovered, $100,000 that had to be taken back off. I even had, heated arguments with their accountant. They were on every call. Don't trust every accountant you guys come across. Get in there and get after it. And at the end of the day, the add backs, they had add backs on the COGS, which meant that they didn't meet up with the tax returns. And while I was able to validate those add backs, because he had 3 businesses running a lot of his expenses through the one I was trying to purchase, the lenders have basically just said, look, that's $100,000 add back in COGS. How can I tell that this Home Depot receipt is an add back and this one is not?
Yeah.
And a lot of stuff, so some of them I was able to throw away, but the rest of them, so look, this deal, I just got off of the last of 3 SBA lenders today. And we just put a fork in this one. She's done. So I'm moving on.
So they were actually adding back costs. I mean, did they even identify exactly what they were, or were they just random add backs?
No, I had a list of probably for the last 3 years, I've had about 200 different receipt line items from their system that I had to physically go through every single one to try to justify them. And again, some of them were very easy to justify. Others we threw away. But when it came down time for the SBA lender, and it was preferred lender, and their underwriting team just said, yeah, sorry, we can't look your tax. You're telling me your tax return isn't right, is what you just told me.
That's why, yeah, part of what I will, throw out there when we can start going through the training is always get tax returns because they're confirmatory in terms of a lot of the expenses. Now, obviously, everything won't match because sometimes cash, taxes are based on a cash basis where someone's accounting may be based on an accrual basis, but they're going to be reasonably close for the most part. But that's interesting. What kind of a business was it?
It was in the construction area, so it was a remediation. Did a lot of demo and mold and asbestos and lead remediation
Okay.
for primarily industrial and government and institutional contracts. I mean, there's just so much room for growth here, but using it as a piggy bank and not cleaning up your accounts prior to listing.
Yeah, that's a typical problem.
Yeah,
I'm just curious though, because the ad backs, just the location of the ad backs running through. It's been rare that I've ever seen a business have significant ad backs running through their cost of sale account. I mean,
165,000.
Yeah, I can understand it like on the salaries line item. I can understand if there was like some insurance or medical costs related to maybe a family member or excess amount related to the owner, that kind of stuff. But I don't think I've ever seen it running through cost of sale because that's the direct cost of actually delivering services to the business, delivering services of the business. So you would think those numbers should comport with reality as opposed to, them running some. Were they personal expenses they were running through there? Is that what they
He
were
was doing business startups and other businesses, so they didn't have the income to offset the expenditures. So he was using the company that did have the income to offset the expenditures.
Oh, okay.
Right.
Gotcha.
And then here's what makes it funnier.
Gotcha.
He had an employee that he made 51% partner in name and on paper because he was able to get SWAM certified. And so this guy was a minority, so he gave him 51%, but made a side deal that says, look, the company's going to pay me all the earnings as a 1099 consultant.
Yeah, that's a good thing you probably let that one go.
Yeah.
That's a pretty good story. Oh, wow. I don't know. Can anyone else out there top that one? No, I think the funniest thing that and I think it probably one of the AEs is on the call that had that business. I think it was actually Alan's business, Karshner's business was Quinn and I had seen the business where the guy was paying his ex-wife so much money out of the business, and it was just like, okay, so what's going to happen when you sell the business and she's not getting the money? Is she going to come after the AE for that money, or you're going to have a real problem? Is she aware that you're selling the business? But that was like the weirdest thing I've seen in the last year or so. But I mean, I guess that's not super weird considering what you just saw, but it was definitely something that was funny when we looked at the line item. And then we had another business we looked at. I won't even tell you guys what the name of this business was, but apparently this guy was paying all of his employees in cash because they were all illegal immigrants. And so it was a cash basis business, but none of those expenses were documented on the financials, obviously, because he wanted to hide it for some reason. So he really tried to get the AE. He basically hid those costs, and he basically said the business was a lot more profitable and cash flow driven than what the AE was thinking as far as the cash payments out. And so the issue really became an issue of, well, if you got this great business and you got these huge profit margins, I mean, how are you doing all this work? I mean, it looks like your wages are very, very low. And he didn't actually tell us that it was actually he was paying employees under the table. He didn't tell us that. It only came to light as we started to figure out that, well, wait a minute, I think it was It was I want to say it was a construction type business, but it looked like he had no employees and he had these fat margins, and he didn't pay, and he wasn't paying contractors either. So we couldn't understand, well, wait a minute, how are you constructing what you're constructing without employees? And then it finally dawned on us that he probably was using, illegal immigrants, and then it was verified that he was using illegal immigrants. And then he tried to come back and say, yeah, but I'm paying him like $5 an hour, and they'll take whatever because I don't, they have no other options or what have you. But it was a very sketchy business. I mean, from that standpoint, because I mean, you can't really. Number one, we don't want to assist in someone buying a business where you're treating a bunch of illegal immigrants in a manner where they have no recourse to actually go after fair wages, because I mean, you're taking advantage of people. We don't think that's the type of business that we want to be involved with. It's not the type of business that we would advise you guys to be involved with. And there's the owner of the business, because he was running the business that way, was we thought he was very unscrupulous. So if you see businesses out there like that, I mean, to me, they're walk away businesses unless you can figure out a way to actually employ people, and pay them, at least the minimum wage. I mean, I'm not arguing that they should get paid more than the minimum wage, but what I'm saying is they should get paid at least the minimum wage so that you're operating the business in a legal manner. But yeah, that's probably a weird business that we looked at as well.
Rich, what's your guidance on what resource to help us with due diligence? I know we had Elliot Holland come in. I think Daniel brought him into the call a few months ago. I know he's a resource. The guys at Aegis, the law firm, kind of position themselves as being able to help. I'd be curious about when to bring in one of those or another resource to help with due diligence.
So we'll kind of get into this. So Elliot, well, first of all, the Aegis or whatever law firm you're using, they're not going to do. There's a whole lot of different types of due diligence, okay, involved in buying a business. We're going to talk about the financial part of it. We're not going to necessarily get into some of the other parts of it. Or we won't, not today at least. But the guys, lawyers, they'll talk about due diligence. They may provide you with like a due diligence list, but they don't want to do the due diligence. First of all, the only due diligence that they're probably going to be a part of is the legal due diligence, where they're reviewing, any material contracts or anything that affecting the acquisition of the business from a legal standpoint. They will review and obviously charge you for that. But they're not going to be involved with understanding, kind of what's going on the finance side. Now, when you get to your close, when you get to the purchase agreement, obviously they're going to, put a whole lot of, warrants and can never say that, indemnifications, within that purchase agreement, to protect you, as the buyer. But they're not going to spend a whole lot of time doing actual due diligence beyond reviews of material contracts. And I mean, if there's something specific, and they're going to look for obviously legal, any potential litigation that's out there, they'll look for that. They'll review any settled litigation, to make sure that there's nothing hidden in there or what have you. And then for any one-off issues, they'll happily review, for a fee. Elliot, and again, we'll talk about this, and actually, and I'll tell you guys a kind of a story internally. We had we're buying a business, and part of what ended up happening is I think Daniel and someone else reached out to me, about the quality of earnings report. And there was some concern that there were a number of issues addressed within the quality of earnings report. And pretty much my discussion with them was, well, you have to understand what the purpose of the quality of earnings report is. It's due diligence, but it's due diligence around a very specific area. It's due diligence around your cash flow reporting, and your financials. but not financial, what I call financial due diligence per se. It's around your accounting processes and making sure that the numbers are what they are being represented as. It's not, they're not doing a working capital analysis. They're not doing, they're not reviewing trends in the business. They're not doing any of that. I mean, it's very specific and niche. So, and to answer your question, Adam, when you would bring someone like Elliot or Aegis in is I wouldn't bring them in before you got to an agreed upon LOI. Okay. Because you're going to end up spending money that you probably, well, I'll couch that from the lawyer perspective. From the lawyer side is separately from someone like Elliot. So from a quality of earnings perspective, I would not bring in the QOE consultant until you have an agreed upon LOI, because there's no sense in having him or her start on a review of that information and charging you for it if the deal's not accepted. Okay. So if the deal never gets signed, then why are you going to spend money on a QOE? That makes no sense. Now, and we'll talk about the purpose of what the QOE is really for down the road here. Now, as far as the attorneys, now that's a different case, because I've told you guys in the past that whenever you get to the LOI writing stage, especially if it's your first one, and you don't have a template, and I'll say it this way: if you're writing an LOI in the state that you've previously written an LOI in, and you have a good template for that particular state, then you probably can get away with not having an attorney review the LOI the second time around. I would always have them review it the first time around. So you probably want to bring your attorney in before you send the LOI at that point. If you're writing, if you've got a template for an LOI and you're buying a business in a different location or different state than what you issued an LOI on before that your attorney reviewed, I would have your attorney at least review it or point you in the right direction of an attorney that can review it from that state. Because, and the reason I say that, just happened to actually a friend of mine. He bought a business. Now both of us live in Arizona, and I helped him review the business. The business is actually located in California. I helped him review the business just from basically perform some high level financial due diligence for him. But he issued an LOI based on the business that he had purchased, or that we had purchased in Arizona, and issued the same LOI in terms of the structure of that LOI. Well, some of the clauses within that LOI aren't allowed in the state of California, or aren't legally enforceable in the state of California, or would subject you to, to some legality in California that would not necessarily subject you to the same legality in Arizona. So he got caught in a snag there, and he ended up losing, I think, $100,000 escrow deposit because he wanted to pull out of the deal, and he couldn't. So that's why I caution you, to always have an attorney, especially if it's going somewhere out of state, out of your normal scope of where you require a business. Have an attorney, even if it's like Aegis, because they're not necessarily licensed in every state, but they understand acquisitions, and they probably have a good idea of what's allowed in each state. And if they don't, they probably have a resource to point you to for an attorney who can review it in that particular state. But I would just always caution, if you're operating outside of your normal geographic range that you're used to operating in, and hadn't issued something in that particular geographic area, then have an attorney review it quickly. It's not going to cost you that much for them to review an LOI. So that's it. That's kind of where I would go as far as when the timing around the QOE and the attorney. Does that answer your question, Adam? I guess so. Anyone else before we jump in? No? Okay. All right. Well, let's talk financial due diligence here. Share my screen. All right. Uh, I just continue to add to our little book here. All right. So, kind of before we jump into financial due diligence, I kind of wanted to talk about kind of the overall due diligence process. As I said before, there's lots of types of due diligence that is usually required in it within an acquisition. Um, some of it is applicable to small businesses. Some of it isn't. Some of it is applicable to home services. Some of it isn't. Some of it is applicable to small and growing technology companies. Some of it isn't. I mean, so due diligence is very specific to each transaction out there. So there's no due diligence, what I would call a due diligence template that works for every type of acquisition out there, because companies are different, informational needs are different, the purpose of the acquisition may be different. As a financial buyer, you may not need as much information as a strategic buyer, which, when I say strategic buyer, again, I'm talking like, let's just say Coke is looking to buy, I don't know, we'll say 7 Up or something. Well, I don't know if they're part of the same company, but whatever. Coke is looking to buy the maker, or Pepsi. Let's just say that, even though that probably is not going to happen. But their informational needs might be different than a financial or a PE firm that may be wanting to buy Pepsi, because they're trying to incorporate Pepsi's product lines into their product lines. They may have some antitrust issues to deal with, so they may have more investigation in terms of markets on that side. There's different reasons for why companies or business owners, or small business acquirers are buying companies. So the process itself can't be templated in terms of step 1, step 2, step 3, step 4, step 5, step 6, step 7, blah 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 blah. It's really specific to each acquisition. So just kind of understand that from a big picture. So, but the purpose of acquisitions, in terms of why you want to do an acquisition, or the things that you need to consider around an acquisition, are pretty much similar. It's just the individual steps. So obviously, I'm not going to go through all of this. You guys can look at this on the deck that I send out. But obviously, some of the most important ones here are, the confirmed material facts related to the business. Obviously, you want to, the brokers are out there selling a business, and they're saying this business, or the owners are selling the business, and they're saying this business is XYZ. It has these benefits, blah, 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 blah. It has this amount of cash flow, blah, 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 blah. Obviously, part of the due diligence is to confirm all the material facts around the business. Another one that's probably important is to reduce the risk of any post-transaction surprises. You don't want to buy a business and all of a sudden find out that, that 8 customers have already signed contracts with new suppliers, and you're one of the suppliers that's currently supplying inventory to this particular customer. Obviously, you can walk out and lose a bunch of business. You could buy a business and end up not having a business, and you would have ended up spending a bunch of money on, some useless assets. Thing that's important from the due diligence process is to create trust between the two parties. So obviously, as you go through the due diligence process and things are being confirmed, you start to be able to build rapport with the seller. There's a trust factor as you become more and more comfortable in the process. So there may be times where you're like, okay, this person has been pretty truthful about what this business is about and what's in this business, and maybe you're 60 or 70% of the way through the due diligence process, and you get to the point where you're just like, hey, I can kind of maybe take his word on a few items, and maybe just do a cursory review and speed the acquisition along. You're building some trust between the two. Now, obviously, on the flip side of that is, if you find something early in the process that you felt like the owner was less than truthful about, the seller was less than truthful about, that could cause you to take an even deeper dive or deeper look into certain aspects of the business. just to make sure that there's nothing else that's being hidden from you. So part of that process is hopefully is to create that trust between the two parties so that the transaction can get executed fairly efficiently. And then obviously through this process you want to identify some potential deal killers. And deal killers, I would say actually you're going to establish some of those at the very beginning of the process of things you don't want to see in a business. This is a way to identify those potential deal killers and let you kind of walk away from the transaction. And then the last one is, you just want to make sure it meets your investment thesis and the criteria that emanated from that investment thesis. So that's kind of high level purpose and goals of the overall due diligence process, not just the financial piece, but all the other pieces of the process. Everything needs to fit within kind of those parameters or be examined using these particular, I would guess, these particular, I don't even know what I'm trying to say here, but you should be using these to kind of assess every part of the acquisition. So you can use these as kind of assessment measures is what I'm trying to get to. Okay, so there's different types of due diligence. I just wanted to list these out here just so you guys can see kind of the overarching aspect of what goes into due diligence. So it's not just financial. I mean, you have your financial piece, you have your legal piece. There's asset due diligence. Assets can sometimes fall under financial, just because you're really going to be examining whatever's on the balance sheet. But the asset, for instance, an asset due diligence is essentially verifying that the assets are there, like a physical verification at whatever locations they are, examining the quality of those assets, examining any warranties or anything around the assets that may still be in force, just things like that. You have administrative due diligence, customer due diligence. That's really going to be only on businesses that you're buying that have a commercial component. You're probably not going to be doing too much customer due diligence on a plumbing business serving residential customers. I mean, I don't think you guys are going to be running credit reports on your, Sally Smith down on, XY at 123 Any Place Lane. Okay. So customer due diligence is more lock you into services, when you can raise the price of those services, that sort of thing. Then you have operational HR audits, due diligence, strategic fit. That's probably not going to be appropriate for you guys until you get to a point where you have a company that's buying another company. And then obviously that's just around understanding the business you're acquiring and whether it fits nicely with your business. Then obviously real estate due diligence on any properties that's owned by the business, tax due diligence to make sure that the business is not a late taxpayer or hasn't paid taxes if they have been owed over the last few years. Obviously, that's a business you want to be real careful of, because that tax burden, if you buy a business that has a tax issue, that's going to most likely fall to you as the buyer, not the seller. You may be able to go after the seller, but the government's going to come get their piece from the current business owner. Environmental audits or due diligence. Well, I got my audit hat on. Those are around. Let's say you buy a piece of property that's maybe you buy something that has. You're buying a gas station. That's a good, perfect example. That would involve, due diligence on kind of the underground storage, whether they have any issues, any brownfields there. If there's a brownfield issue, I won't go into that, but it's more or less, has to do with underground storage, and the government, make sure that you're complying with all legalities around that. If you're buying a business that is emanate or putting out, CO2 emissions or whatever, just making sure that the businesses are complying with the laws around the environment, their local environment. And then there's tech audits. So if any of you guys are out there, some of you guys have started technology companies in the past, but if you're buying a technology company, Obviously, part of your technology due diligence is to understand if there's licensing, patents around that. Basically understanding the IP around that technology, who owns it, making sure it's strong. That will encompass some of the legal audit or legal due diligence as well, because you'll probably have to hire a patent attorney to review any patents related to the technology, to make sure that it's legally enforceable and that your company actually owns it. And you're probably not going to spend a whole lot of time in that area, especially on the businesses that most of you guys are looking to acquire. But that's just another part of the due diligence process I wanted to throw out there. All right. So now let's jump into financial due diligence, the types and kind of the differences between the two. Okay. So they have, there's what we call quality of earnings due diligence, and then the other part of that is what I call analytical due diligence. And again, you guys jump in for anything that you don't understand. Sorry, I have hiccups here. Jump in for anything you don't understand or you have a question about or you'd like to discuss, and we can definitely stop and discuss it. It looks like we've got a lot of time. I don't have a whole lot of slides here, but I do have some additional slides beyond this, but I think we'll have enough time to get into some discussions as needed. But a QOE is really an accounting driven report. So it's based around the company's historical accounting, and how they've accounted for revenues, expenses, how that translates into cash flow. And it's really geared to kind of get you comfortable with the numbers that they present are actually the numbers that actually exist. Because what's important and why you want to get a quality of earnings done, number one, you want verification because you're buying businesses and you're buying them for, at a multiple of earnings or a multiple of cash flow. And when I say cash flow, I mean either EBITDA or SDE. So we're just use cash flow kind of as that number. But you're basing your value of the business on those reported numbers. So you want to make sure those numbers are right. You don't want to be basing that decision or that valuation on bad numbers. Okay. So the purpose is to verify the cash flow of the business and the sustainability of that cash flow. And that kind of ties into the fourth one. I'll jump around here, which is really identifying and validating the add backs and adjustments to reflect the normalized earnings and cash flow. So when part of what the QOE is supposed to do is to get you to what the actual EBITDA or SDE, again, I should just say cash flow, what the actual cash flow looks like over, let's just say the previous 3 years, so that you can figure out what that normalized cash flow looks like. And you can base the value of the business on what that normalized cash flow. So for instance, if you have a business, let's just say the broker presents a business that shows in 2020, it has $100,000 in cash flow. 2021, it has, we'll keep the numbers simple, $200,000 in cash flow. And 2022, even though we're not there yet, has $300,000 in cash flow. Okay. Now, when you go back through the QOE and they identify, and that number is inclusive of the add backs that the business broker or the owner has said are the legitimate add backs. Okay. Now, when you go through the QOE, those numbers get verified against the banks, against the bank statements that come from the bank. And typically, QOE will try to garner those bank statements directly from the bank instead of getting them from the owner. Sometimes they can't get them from the bank. The owner won't give that approval. But they're going to gather all these bank statements. The number one, to verify kind of materially what those numbers look like, at the start of the year versus the beginning of the year. I try to identify what the revenues are that were going into the account, the expenses that were coming out of the account, to get to some normal number that verifies kind of what the financial statements are saying is the cash flow. Then what Elliot or someone else would do is we'll go back through that and go through the general ledger specifically on a month-by-month basis to ascertain what's really an add back and what's not an add back. So what's a normal expense versus what's in excess compensation for the owner, what's what's an expense, and if the owner is running his boat expenses through the business, kind of identifying all that stuff or whatever. And so they will get to a certain number. So now that report may come back and say, well, in 2019, maybe the cash flow wasn't $100,000, it's $50,000. Maybe in 2021, instead of $100,000, maybe the legitimate cash flow is $150,000. Maybe in 2022, that number is, right at $200,000, for instance. Okay. So now, based on Elliott's report, you have what's identified as kind of what those actual cash flows are that you would have as the buyer of the business that would continue through the business. And then it's your job to kind of say, okay, well, in 2022, maybe they had a huge year. That's probably not going to happen. In 2021, maybe that's a normal year. Maybe in 2020, they were below where they normally would be. And so maybe 2021 is the number that I would like to use for my normalized earnings that would carry forward, or my normalized cash flow that would carry forward going, through that process, and on and on and on. That's probably the number, as you go through and you kind of identify that probably is the number that you're going to lean heavily on towards your evaluation. And you can explain to your seller why you're leaning towards that number. Okay. So that's kind of what the purpose of the QOE is for. It's not meant to identify kind of what the working capital trends are, what the sales trends are, and identify. It's not meant to ask, or not meant to identify and answer the how and why questions. It's more about what happened. This is what we say, what we think has happened versus what the seller is saying happened. And then they give you an assurance report. This is, you should feel comfortable that these are the numbers that you should base your valuation off of. And again, that's here. I have confirmation that reported numbers are what is as represented to the buyer. It's the basis to establish the valuation before the deal closes. Okay. So you may come in with a preliminary valuation on the business based on the numbers that are presented before you even get a QOE done, and that's fine. But obviously, as you write your LOI, there are going to be a lot of subject to clauses within that LOI. We've talked about this. You could make it subject to your QOE report confirming the numbers that are represented, blah, 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 blah. But you're going to protect yourself so that you can address valuation post the QOE report, because that QOE report is usually going to come in, and it's going to affect the value that you're really going to see the business as having. So you want to make sure through your LOI process, you create, room for that. And then within the QOE report, because they're looking at accounting issues, they're probably, any good QOE provider, it's usually a CPA firm or someone like Elliott. I think Elliott's a CPA. And again, I used to do some of this as well as a CPA, but what you get from those reports is you're going to probably get some addressing of issues around how they account for their numbers. And so typically what you see with a lot of small businesses, they, within that report, some of the issues that might be identified would be the lack of internal controls around their financial accounting, meaning that they may not have a CPA doing it. They may just have a bookkeeper, and that's fine, but the bookkeeper may not be well versed in, accounting principles. So, maybe they're, just throwing things in different accounts that they shouldn't be. So things like that will be addressed. Things around actually the timeliness of when they're actually entering the information. So little basic accounting issues will be addressed within our report so that you can understand the risks around the business as it stands right now. Because there's nothing worse to hear than a business has a lack of internal controls, which means $100,000 could walk out the door and no one would be wiser the difference. So you want to make sure that you're not subjecting yourself to that. And so consequently, the report will sometimes address some of those issues. Sometimes it won't. Sometimes it'll strictly address kind of the cash in and the cash out, and tying it to the current financials. But at least it'll give you some comfort level that the numbers for that particular period are what they are purported to be, or hence the adjustments that should be made to those numbers. Okay, so that's the QOE. The analytical part of the business is really built around understanding the business, not just the accounting. So that's kind of the difference. And I'll kind of walk you guys through an example of kind of a funny example of how it was explained to me as a youngster. But it's the purpose is to understand the business, understand the trends in the business, revenues, gross margins, costs, etc. How the business is financed, working capital, debt, equity, blah, 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 blah. But the whole the whole purpose of the analytical piece is to ask how the business is doing and how we project it to do, and why is the business doing what it's doing. Okay, so it answers the questions how and why. Those are the most important to you as the buyer. Yes, it's important to understand the cash coming in, the cash going out, to understand what the cash flow of the business has been over the last 3 years, but you want to understand how the business is generating those cash flows and if they're sustainable and why. Are they in the right businesses? Why are margins shrinking, or why are margins growing, or what have you? So that's the whole purpose of the analytical piece. Now, all that being said, if you guys are still, the easiest way for me to kind of explain the differences, because a lot of people still don't get it. But let's think about it this way. So my old manager gave me this analogy demonstrating the difference between the QOE and analytics. He said, and he basically kind of couched it this way. Imagine a close friend, like, entrusts you to buy him a used car. So your friend calls you up on the phone and says, "Hey, I want you to go buy the car for me, and you pick it out. I trust you. Let me know what it is, and give me a call back." So you go around having searched the classifieds, you find what appears to be the perfect car, and the seller provides you with a certificate from a reputable mechanic. Okay. Now, the purpose of the certificate is to provide a certain degree of comfort that the car is roadworthy. So it works. There's nothing wrong with it. Okay. Now, the certificate might be verifying that the car's roadworthiness. Can never say that word either. It might verify that it works and it's nice, but you may insist on performing your own due diligence around it, right? Personally inspecting the car and kicking the tires and taking a test drive might make you more comfortable about your friend's potential purchase, right? But in fact, you may even want to hire another mechanic that you know and trust to perform a more thorough inspection. Now, so your friend bought the car, got a certificate, car said it's roadworthy, but you want to get a second opinion on that. Okay. Now, your mechanic probably knows more about your specific concerns because he's your mechanic and can delve deeper into the car's history, its operational features, and its maintenance record to help you decide if it's a limit. Okay. So the analytics part of due diligence is that second mechanic. So while you may have the certificate that says, "Oh, the car is roadworthy, there's nothing wrong with it," or what have you, that's just telling you that it's roadworthy. That doesn't tell you whether the car will continue to run thereafter, and you won't get that until your mechanic goes through and kind of works through, the car's history, its operational features, its maintenance, whether the car's been taken care of. That will kind of tell you over the long haul whether that car will continue to work. So that's it's kind of a weird example, but that's kind of how it was explained to me. So the QOE kind of tells you right now at this point in time, the car can run. The analytics part of that would tell you whether the car can continue to run. And so that's really the difference between the two. Does it make sense? Yay, nay? You don't care?
Makes sense.
All right. At least I got one confirmation. Thanks.
Yeah, that makes sense.
All right. So now around the scope of due diligence, of analytical due diligence. Okay. Again, you guys will get all of this, and this is not all inclusive, but these are the basics that you guys should get to start your piece of the financial due diligence. This will also be a lot of the information that your lender will look at. And again, as I said earlier, your lender is going to do a lot of the work for you. Now, if you are just a cash buyer and it's coming out of your pocket, you're going to do a lot of this work because you're not going to have a lender to lean on to do it. But a lot of the times in the underwriting process, they're going to ask for a lot of this information, and they're going to do a lot of the the go or no go, whether they're going to underwrite that. Now, that may not be the end all be all decision, because you may be able to take this to another lender and they may look at it and say, oh yeah, everything's great. But at least you're going to have someone who's kind of walked through it. And at least on that first lender, if they decide to turn it down, you can ask them, what's the issue that you saw in the business? And voila, you can decide whether that's a deal breaker or a deal killer, or whether it's something that can be worked through and you can move on to the next steps of due diligence and move on through the acquisition. Okay. So, I mean, the basic stuff you need, and we've already talked about this in the past, I would say for financial statements, and we just had an example of why you want to get tax returns. But you want to get P&Ls for the last 3 years, if possible. If a business hasn't been in existence for longer than that, then you're probably not going to get it. Obviously, you can only get what they've been issuing for the last maybe 2 years or 1 year or what have you. But you want to get P&Ls for the last 3 years. You want to get tax returns for the last 3 years. Really, that's confirmatory. We already talked about that. You don't want to have issues where there's significant difference between the two. You want to try to get balance sheets for the last 3 years. Again, we talked about this a little bit last week. You want to be able to kind of assess your working capital, and you need balance sheets and P&Ls to get to that. I would say for the last 12 months, try to get monthly P&Ls and balance sheets. You may not be able to get them, but you can always ask. Okay, you're a lender. It'll make it a lot easier for your lender to determine what your working capital needs are if you don't want to go through that exercise. If they've got 12 months of monthly balance sheet and P&Ls to work off of. Okay, it's a simple exercise, but it makes it easier for them rather than trying to guess. Get all your corporation docs. You obviously want to make sure that the owner actually owns the business. Very important. I've seen someone try to sell a business, they didn't even have ownership or enough ownership to sell the business. So you want to get your incorporation docs, which kind of lists out the owners, shareholders, all that stuff. Equipment list, obviously you want to understand the equipment in the business, how old it is, whether it needs to be replaced, understanding what's there, but maybe you can borrow against it long term. The UCC filings, you want to get those as well. The UCC filings will basically indicate what, if there's any liens on any of your equipment or other assets in the business. You always want to understand that because those are basically debts. Vehicle and trailer titles. If you've got a business that has vehicles, obviously you want to get a list of those vehicles or trailers and all the titles related to that to make sure the ownership is what it is, and obviously that those titles can transfer to you. Revenue by customer for each of the last 3 years. This is going to be more B2B, more businesses with commercial components. You guys should know that by now. I would say get it for the last 3 years because you want to effectively see the changes in the customer base, whether those customers are stable, the same customers are stable, whether that customer base is increasing. And obviously you're looking for any customer concentration issues. Okay. AR and AP aging reports for currently and for each of those annual periods, as well as the last 12 months if you can get it. Again, helps you establish what that working capital number needs to be, which is important in the acquisition of the business. Any leases regarding real estate, evidence of ownership, and what they actually own. And then if you can, one of the things I would always say you want to get is a narrative of the condition of the assets, meaning if the owner can write out for all of the assets that are listed through the equipment list or vehicle and trailers, real estate, any other equipment or assets. Obviously, real estate, there's probably not anything they need to write for a condition from that standpoint, unless the building's really horrible, and I'm sure they wouldn't write that. But a narrative around that, because there's probably going to be, if it's old equipment, you're probably going to have some replacement costs, which is going to affect the cash, the SDE or cash flow that we talked about. So you need to account for that in the valuation of the business, because if you've got a $500,000 SDE business, but then you realize you're going to have to replace $250,000 worth of equipment, then what's your goal forward SDE? I mean, yeah, it's going to dip to 250, and maybe it'll rise back up to $500,000, but in essence, they've capitalize this business for a number of years if they haven't been replacing the old equipment, and you don't want to reward them for that. Okay, you want to make sure that they get somewhat penalized for that. Customer contracts. Any major customers that are under contract, you want to get a listing of those contracts. You want to review at least the most lucrative, or the most, I guess, the contracts where you're deriving the most revenue from, and a template of what the contract looks like to understand kind of the contractual obligations that you have to a customer. Yes, there are contractual obligations to pay you, but there may be warranties involved where you may have to deliver certain maintenance in order to earn certain revenue. And again, that affects your cash flow going forward. So you want to make sure you have a thorough understanding of that. Other relevant docs, again, not everything is, each acquisition is different. So there's going to be other relevant docs that I just threw it under there that you're going to need to ask for on a case-by-case basis. And I could end up writing out, 3 or 4 pages worth of other relevant docs that, wouldn't necessarily be material to a home service business. So I didn't want to include that here, but there's other relevant docs you're obviously going to get to examine related. You're going to see a lot of this information in the financials. So it'll lead you to ask questions about these things. And then companies that are growing. So if any of you are buying like a company that I bought, which was, the manufacturing company, or you're buying something in a high growth industry, try to obtain a company forecast to see kind of where their thinking is in terms of the growth of the business. Obviously, you don't want to put blind faith in a company forecast, because obviously they're going to make it look better than what the actual environment may look like down the road. But you want to get an idea of kind of what their thinking is regarding the revenues and trends, and where they continue, revenues and their cost of sale. There are any supply chain issues that they kind of forecasted into that business. Kind of what their cost structure looks like from an employee base, and how they're kind of forecasting the growth of headcount. So you always want to try to understand that. Most companies that you guys are buying, that's not important. Like, again, I've talked about this before. Home services businesses, I wouldn't worry about a forecast. It's not like you're going to be creating, something so unique that it's, that you need to develop a forecast around it. Looking at the last 3 years is probably a good indication of where the business is going over the next 3 years, unless they've got a bloated cost structure that you plan on cutting out of the business that you recognize, and or there's a significant contract for a larger, commercial customer that they're bringing on board, and it's not reflective in the financial statements as they exist. Okay, so that's a little bit about the scope and documents. Now, your analysis, again, all of this is kind of the high level stuff you want to look at. Again, your bank is going to do a lot of this. Elliott's or whoever is going to do a lot of the quality of earnings stuff. So, or all of that. So really, there's some key things you want to look at. There's some key questions, obviously, outside of the financial piece of this that you're going to be asking. But within the financial piece of this, your analysis should be around major customer accounts, looking for customer concentration. Okay, that's an easy calculation, easy worksheet. Basically, take their top customers, or take their customers by revenue that they'll send you, spreadsheet them out, see who's making up more than 10 or 15% of the business, and ask yourself how stable that customer is. Is it a contractual relationship with that customer, or is it a handshake agreement? And adjust accordingly. Okay, that's fairly simple review. Identifying your fixed and variable costs. Okay, you want to identify what costs are going to remain with the business regardless. Things like leases. If they're long-term leases that you're buying the business with, that's a fixed cost in the business. There's not a whole lot of fixed costs in businesses at this size, but leases, you're going to have, obviously, if you own the building, I wouldn't say mortgage costs, because the mortgage is usually specific to the buyer. If you're buying the assets of the business or buying real estate in the business, it's going to be your own mortgage, but you can factor that into kind of your forecast moving forward. But you want to identify, your leasing costs if you don't own the business and they're in a long-term lease. You want to identify, you know, what I would call fixed headcount versus variable headcount. When I say fixed headcount, that's going to be your administrative staff. That yes, you can cut them out if business goes south, but it's not like you want to do that. So I'd almost call them as fixed costs. Your variable headcount costs might be, you know, salespeople that are on commission. They're not variable in terms of them being in and out of the business, but their costs are variable because they're obviously based on closed sales as opposed to a fixed salary. You want to identify, obviously fixed costs would be, maybe your telephone costs are fixed for the most part. So there's some fixed costs you want to identify that will continue onto the business, whether you buy it, when you buy the business, those are going to be costs that you're going to be servicing. Anyway, you want to identify those variable costs that are going to be really dependent on where your sales, your gross margins are. Because that way, when you kind of build out your forecast as you're buying this business to see if you're going to be able to service that debt, you'll understand that, hey, I'm buying this business. I plan to ramp up sales here. Here where my revenues are going to go up. Here where my costs are going to go up. Here's my fixed component. How does that service my debt service? Can I service my debt service if I grow the business this way? What if the business falls this much? What are my fixed costs? What are my variable costs? And how does that affect the bottom line? And how does that affect my debt service? Obviously, internal controls, you want to try to get to an understanding on that. You're not going to necessarily get to that. You can ask the owner about, how do they make deposits and all that kind of stuff. But that's really for a larger business. I'd say probably for your businesses your size, probably not important. Understand your order book and sales pipeline. You want to review that because obviously that's future business. That's locked in business. You want to understand what you're buying and what that outlook looks like over the short term. So try to get a hold of what the sales pipeline looks like. They usually have companies that are well run have pipeline reports. Mom and pops that aren't well run probably have that written down on paper somewhere. So at least try to get an understanding of that. And then obviously from all the financials, we kind of talked about this. You want to do a working capital analysis to understand the minimum level of working capital you need in the business because you don't want to be paying for excess working capital that the owner is going to try to stick you with. Okay. So in essence, they're going to try to charge you for the earnings in the business, and then they're going to try to charge you for the assets related to working capital. You don't want to get double dipped from that standpoint. And then you want to understand kind of if there's any needs to replace equipment, trucks, vehicles, which goes back to understanding what's on that equipment and asset list and kind of trying to get a narrative around that because that factors into what your bottom line SCE is going to look like over the short term. And then it could affect it over the long term if you have to continually replace equipment, if there's short-term equipment from that standpoint. And then you want to review any contracts related to debt that may stay with the business after you purchase it. Now, a lot of times these acquisitions are done cash and debt free, but sometimes there are debts on the business that aren't paid off through the acquisition. Okay. And so they may be servicing specific assets that actually stay with the business. Okay. Now you can get those debts refinanced, but you need to understand if those debts can be refinanced. Because sometimes they'll lock in debts and put maybe they got a asset loan on some equipment. It's going to stay with the business, but there's a lock-in period or refinance penalty to refinance that debt because it's a high-yielding debt and they signed a bad deal. Well, you need to understand stuff like that, okay, around that. But if I'm looking at this, these are kind of the high-level things that you will look for on your financial due diligence. Now, there are obviously other questions you want to ask around employees, around the business, operations, around the sales and marketing, system, around HR, around, as we said, around taxes, that sort of thing. But those aren't necessarily part of the financial due diligence. This was really isolated on some of the key things you guys should look at and you should be able to understand. And really, if you get to understanding most of these issues around this, you're really going to be okay. This is probably 80 to 90% of it from a financial standpoint. Okay. Again, but this is outside of QOE, and this is outside of what your bank's going to do. Okay. So, but from this perspective, if you guys get to this and you get comfortable here, then and your bank's comfortable and the QOE looks good, then from a financial standpoint, you're probably good to go. Okay. Any questions about that? No? Okay. Bye. No. Good. Now, what I could have done, I'm not going to do it at this point. I might point you guys in the right direction. I may actually write something up that is more detailed and actually show you guys how to actually review this information. But for the purposes of this call, we could be on this call for like 8 hours. And this isn't a full-on course. Yeah, what's up, Doug?
Hey, Rich, outstanding presentation.
Thank you.
You said you're gonna give us slides.
Oh, you mean a copy of this?
Yeah, this presentation.
Yeah, I'll stick it out there as soon as we hop off the call. But again, yeah, if there's a specific area that you guys would like me, and this will count for anything that we present or that I talk about, even on the operational reviews, or an asset review, or I won't really have expertise around legal reviews, and maybe we'll have the guys from Aegis on if you guys have a specific question about that. But yeah, if you guys want to see how to actually do an analysis on a sales pipeline, I'm willing to have a specific class on how to do that. I mean, if you guys want me to write something up at some point and then present it to the team or present it to you guys, the AEs, I'm happy to do that, especially if it's an area that I have some comfort level in. If it's not an area I have a comfort level in, I'll probably have someone come on and probably talk about it, and then maybe, kind of show you guys how to do that. But if you want to understand how do I identify fixed and variable costs, I can walk through an example. We can have a class just on that. How do I analyze major customer accounts? We can have a class on that. How do I actually do the working capital analysis? Yeah, you talked about it, Rich, but now show me an example of how to do one with a business. So basically, kind of walk through a case study on any of these areas. If you guys ever want me to do that, you guys can send me suggestions, and if there's enough people that have an interest in it, I'm happy to do that. Okay, not an issue. But that's it. Any questions? None? Thanks for jumping on.
Thanks, Rich.
All right. See you guys next week. I'll try to send out the topic by Friday instead of waiting until Tuesday. But again, that just depends on my schedule. But take it easy, guys. Thanks for jumping on.